In this video, I'm going to explain to you the analysis profit when stop loss adjusted versus profit when not adjusted. Have you ever wondered after a trade whether it was a good decision to adjust your stop loss during the trade? This analysis shows you the facts whether your adjustment actually gave you a better payoff or not. The analysis simulates the payoff in case you would have not adjusted your stop loss in the given situation and compares it to the payoff you actually had with the trade. The analysis only takes situation into consideration in which you were in loss with your trade and adjusted the trade to a level which is further away from your entry price. Using a stop loss in trading is pretty much always advisable, but there are some important considerations when using a stop loss. The stop loss should reflect your original trade setup when entering the trade. To my opinion, the stop loss is one of the best reflections of your strategy in trading. If trading based on technical analysis, your stop loss will most likely be positioned at a level at which your trade setup is not valid anymore. For example, if the price of the asset has been increasing and is now approaching a resistance level, you might enter a short position with your stop loss above the resistance level. In case the price keeps increasing and breaks the resistance, your original trade setup is not valid anymore. Hence, you rather want to stop the trade by placing your stop loss accordingly. Moreover, the stop loss is also an integral part in your risk and money management. By calculating the potential loss in case your stop loss is hit in a trade, you can size your position. If your stop loss is 20 pips from your entry price, you trade EUR/USD, and you want to risk 200 USD at maximum in this trade, you can derive your appropriate loss size for this trade. You can risk 10 USD per pips, hence your position size would be one lot in this case. If we look back to the example, in which the resistance line was broken and hence the trade setup is not valid anymore, if the trade was stopped at the stop loss, the trader would have lost 200 USD in this trade. Lost trades are never great, but part of trading. Imagine the trader is seeing the price slowly approaching the resistance level, breaking through it a tiny bit, but not yet reaching the stop loss. The trader starts to feel that the stop loss is most likely hit soon. The trader is annoyed to lose another trade. Looking a bit further, the trader sees another resistance level 25 pips higher and quickly adjusts the stop loss to the new resistance level. The trader saw a new resistance level. So was the decision to move the stop loss rational? Of course it was not! First of all, if the new resistance level is really a strong one, the trader could have just closed the trade and opened another trade when being close to the new resistance level. In this case, the trader would have not lost another 25 pips in this trade while the price reached the next resistance level. Secondly, the trader does not stick to the risk and money management. With now a stop loss probably 50 pips away, the trader is risking 500 USD in the trade, although only 200 USD would be appropriate based on the risk and money management. Third, in most of the times, we make worse decisions when we are under stress. In this situation, the trader was under stress because he or she was about to lose 200 USD. Under normal circumstances, the trader would probably rationally decide to close the trade, and under normal circumstances, the trader may not have interpreted the next resistance level as a strong one. We tend to see what we want to see in a chart, and in this case, the trader wanted to see a new resistance level, so he or she can justify not taking the lost trade. Overall, in this situation, the trader is not only acting not rationally and risking a higher amount of money than planned, the trader is creating an even more dangerous situation. When the price approaches the next resistance level, the trader is likely to be even more influenced and under stress. The current loss already stands at 500 USD, amplifying the stress level of the trader, most likely leading to even more costly and irrational decision-making. Adjusting your stop loss in a trade to give yourself more space may be a good decision sometimes and according to your strategy. However, oftentimes adjusting the stop loss in a way like this creates high risk and potentially large loss for the trader. Therefore, we measure your average trading performance in case you adjust the stop loss of your trade versus if you would not have adjusted your stop loss. Now, let's have a look at the chart. In the chart, you see two bars. The first bar represents the actual average payoff from trades in which the trader adjusted the stop loss to a level that is further away from the entry price while the trade was already in a loss. You can view this average payoff both in pips or in percentage. Please note, trades are only considered for this analysis in case there has been a stop loss set at the beginning of the trade or shortly after. The second bar represents the same trades in case the trader would have not adjusted the stop loss to a level further away from the entry price while already being in loss. The payoff for the trade is simulated based on the stop loss set at the beginning of the trade, hence the original trade setup. This trader has an average loss per trade in case the stop loss was adjusted of minus 11.4 pips, which is based on a total of 82 trades. Those 82 trades yielded a total loss of 4,111 USD, as we can see when moving with the cursor over the bar. If the trader would have not adjusted the stop loss in those trades, the payoff would have still been negative. However, only a loss of 1,875 USD or minus 5.2 pips on average per trade. Therefore, if the trader would have not adjusted the stop loss, the trader would have a better trading result of 2,236 USD. You can calculate this by taking the difference between the results of the two bars. This analysis can be a great help to challenge your current behavior in case you see that the stop loss adjustments actually give you a worse payoff. Not every one of you will see a result that outlines a worse payoff in case the stop loss was adjusted further away from the entry price. Nevertheless, it will still be important to ensure a rational decision-making and do not bring ourselves in a situation in which a clear mind is at risk and we have to act rushed. Rushed decision-making often do not give the ideal outcome. The target for this analysis is not to have a bar that shows a better payoff for trades in which the stop loss was adjusted, but to have as few trades as possible in the category. If the chart shows a much worse average payoff, but this is only based on one trade, this is a good outcome. You may also choose to every once in a while check the chart based on the last 1 or 3 months to see whether you did have trades in which you adjusted the stop loss further while already being in loss with that trade. In case you do have a worse payoff, in case you adjust the stop loss to a level further away from your entry price while already being in loss in a trade, you may choose to receive a notification from us warning that your current stop loss adjustment on average leads to a worse result. Trading can be very demanding, and a little technical support may actually help to free your mind and focus better.